On a very big day for the banks, UBS Managing Director of Large Cap Banks and Consumer Finance, Erika Najarian, joins us this morning. Great to see you again, Erika. Appreciate the time.
Hey there. Of course.
Talk about issue of a report card for today's numbers, and then, if you can, let us know what it means for the broader space, and if there's any sort of sense of clearing or relative calm, given what we know about underlying issues in say, commercial real estate.
Sure, I would give an A grade to today's results, but keep in mind that the banks that reported today are generally considered the highest quality in the industry. And while, let's say, JP Morgan was an A plus and perhaps, PNC was a B plus, I think this is not necessarily the clearing event that the market needs as some of the mid-sized regional banks start reporting next week. That being said, I think the stocks have really, priced in a lot of EPS cuts already. And I think what we're learning from the regional bank that reported today is that we will see revenue expectations get cut, but I think that most of those cuts are already priced into the stocks.
As far as the consumer goes, I mean, it didn't read like an environment where the consumer is maxing out on credit cards. But, I mean, does it feel more like a normal, sort of normalization regarding charge-offs and consumer that going into a cycle?
Yeah, keep in mind that the base of losses and delinquencies and non-performing loans from which we're coming is really, really quite low given all the liquidity that had been pumped into the system during the COVID pandemic. And so, the direction of travel has to be up. But to, answer your question directly, Carl, it is more like a normalization of losses, rather than something that is more alarming.
But there clearly was a surprise here, Erika. JP Morgan's up 7.5%. I mean, a lot of these bank stocks have gotten pummeled. Citigroup's up sharply as well. Bank of America, even the big banks, which we knew were in better shape, had been really beaten up on worries about deposits, right? Higher deposit costs. And those costs are rising, net interest margin. So as far as the read on the big banks, did it give you enough information going forward about what some of those concerns were?
Yes. So look, I've never screamed when I've opened a bank presentation PDF, and the outlook for net interest income at JP Morgan at 81 billion was so far ahead of consensus and so far ahead of even more lofty buy-side expectations. I think that's why the stock is running today. And, Citi at well below tangible book, the expectations tend to be low there. But to really summarize what the lesson here is for the big banks themselves, that despite being heavily regulated, despite operating in a tight credit box, their ability to maximize profit on higher capital is pretty significant when there is some height to the interest rate environment, even though deposit rates are catching up. Really, the lesson here is that what's not great for the banking industry and the economy in general is when rates are at zero for nearly a decade.
But when we hear from the other regionals or mid-tier banks, are we going to be concerned again for the parts of the banking industry, in your opinion, given what we're going to see in terms of their inability to grow?
I don't think so. I think certainly they're not going to be anywhere near what we saw from JP Morgan. And I do think that these mid-sized regional banks will have to revise lower any revenue guidance because of increasing funding costs. That being said, the amount of panic and sort of, existential questions that have been priced in particular into mid-tier regional banks has been extreme, in my opinion. And thus, when we see the results, right, it's definitely a pinch in terms of higher funding costs, but the results are not going to be as extreme as feared.
Well, we got the first batch down, and we look forward to more next week. Erika, appreciate the help. Good to see you as always. Erika Najarian.